Well, the first solution you have is to talk to the bank about getting your rate fixed, especially if you're on an adjustable rate. Why is this healthy? Because they would rather fix your rate and take some losses than not fix it and then take a loss of at least 50% if they had to foreclose. So keep that in mind. They really don't want that foreclosure. A lot of people have the misconception that banks want to get these houses back. That is the last thing that they want. So they want to try to keep you in it. And you really, for your own sake, want to try to keep that house also. So talk to your banker. Do not wait till it's already too late. Talk to them up front. They can also, as well as doing the refinance, the fixed rate, if you're delinquent, they can also put that on the back of the loan so you're not currently delinquent. So it'll make you up to date on a fixed rate. So talk to them about deferring that lateness to the back of your mortgage. That's a possibility. The second possibility that you might have is to refinance your home. Now, you might say, why would somebody want to refinance my home? Well, there's some actual products available to you now, especially if you had an adjustable rate mortgage. One's called the FHA Secure Program. The FHA Secure Program allows you to refinance if you are current when your adjustments on your adjustable rates changed. Even if you've gotten behind later because the interest rate increased, if you were current before them, they will allow you to refinance it under that program. Obviously, you have to qualify for the mortgage and there's certain limitations, but it does give you an option to try to get your mortgage back up to date. And the delinquency part of it, they'll add to the mortgage. So you'll start with a new fixed rate mortgage with a balance that is a little bit higher, but with an interest rate that's substantially lower, and it should help you on those mortgages. The third option is the short pay. A short pay is basically where you don't pay your full amount in paying off your mortgage loan. So if you have a house that was originally worth $300,000, that's where you had the mortgage, and now it's only worth $260,000, the banks sometimes will lower that balance to $260,000 for the payoff amount. Well, that sounds great on its face. It's like you've made $40,000. But that's exactly what the IRS thinks. You just made $40,000. So be careful. Most real estate agents don't tell you about the cons in that. Because if you later think that you've got everything about to get back together and now you're handed a $40,000 1099 and have to pay another $12,000 in taxes, that may not be as good as you think. They are looking at changing that option in Congress right now, which we hope will happen, because the last thing we need is, after we've been killed in the real estate market, to also be considered that you've made money during that whole killing. That just doesn't make sense, but who knows? The government's the government. What do you expect? So just keep that in mind, and let's get yourself back on your feet.